Hello and welcome to our latest Money Show Money Masters podcast segment. I'm Mike Larson, editor-in-chief at Money Show, and today I'm pleased to welcome Christine Benz, director of personal finance at Morningstar, to the show. Christine, how are you?
Mike, I'm good. Thank you for having me on.
Yeah, I'm glad we could talk. I mean, there's so much going out there in sort of in the markets and the economy and the finance arena. So I guess I want to start big picture here. I mean, we're in this economic and market environment. What are some of the biggest personal finance challenges that you find yourself talking about to clients and people? And what are some tips that you'd share to help them cope?
Yeah, one of the big ones is that we've had such a long running equity rally. And I'm concerned that some investors have not rebalanced or taken any risk out of their portfolio, that they haven't taken any steps to elevate their positions in bonds and cash. And of course, interest rates have come up a lot. So the yield that you receive on those products are much better than they were a couple of years ago. But I think that it's very difficult to step away from an equity market that's been as strong as this one has been for as long as this one has been strong. And so I think that's a risk factor, not so much for people who are in their 20s, 30s, even early 50s, 40s, early 50s, but people who are approaching retirement. It does seem like a good time to potentially take some risk out of the portfolio. And I think that's something that we investors just aren't naturally inclined to do. We just kind of want to let the winners keep on rolling. And there may be a pause in the equity market eventually. And at that point, especially if you're close to needing to draw upon your portfolio in retirement, you want to have safer investments to draw upon in those types of periods. You don't want to have to touch your stocks when they're down, which is really the benefit of de-risking. You need equity risk in your portfolio, but you also need some safer stuff if you're getting closer to decumulation.
Okay, let's talk about that for a little bit. I mean, a couple of years ago, we had the scenario where the 60-40 plan, I guess you could say, failed or just didn't do what people were hoping would do. You have more investors that are kind of turning to alternatives and working that in. How do you see that unfolding? Do you think that's the way we should be going? Do you think 60-40 will provide the kind of insurance component that we need, or what's your view on that?
2022 was a rare year when the standard mix of 60% equity, 40% bond didn't deliver. We had a period there where rising interest rates caused pain for both stocks and bonds at the same time. Those periods haven't been unprecedented in market history. But I would say that you don't want to build your portfolio around the potential that such an environment might arise again. To my mind, holding an element of cash in a portfolio makes a ton of sense to help provide you with if you are needing to take from your portfolio during such a period, having some liquid reserves is, I think, a smart strategy. I usually recommend that people have, if they're in retirement, something like 1 to 2 years worth of cash to draw upon. So 1 to 2 years worth of anticipated portfolio withdrawals. Obviously, if you're still working and earning an income, you need much less in cash, more like 3 to 6 months worth of living expenses. But I think that simple cash bond stock portfolio is probably all most investors need. Alternatives, of course, are a very broad basket. And when we look at the data on which alternatives deliver or best help diversify a standard U.S. equity fixed income portfolio, there are a few categories that have held up pretty well. So managed futures, for example. But I would say the big caveat, at least in my mind, with alternatives is just the higher expenses that typically accompany them. And so I think that can potentially eat into whatever return you're apt to earn. And these are, and of course, it's a very big tent, the alternatives category, but this is not typically a high returning asset class. So you want to be very careful about not seeding a big percentage of your return in expenses, which unfortunately, when we look at the managed products focused on the alternative space, many of them are on the higher cost side of things.
Okay. Let's pivot a little bit here. If we look at the big picture environment, I mean, it seems to me it's kind of a slowing growth, not recessionary, backdrop where we're probably going to get at least a couple of rate cuts over the next several months. How does that impact planning and what people should be doing or thinking about doing in their portfolios?
Well, I mentioned the issue of de-risking, and I do think that that's a smart strategy to potentially look at your targets for your asset allocation and see where you are today. If investors have been very hands-off, their equity allocations have naturally drifted up a bit. So look at that baseline asset class exposure. Also look at the complexion of your equity portfolio. We've had a period where a very specific subset of stocks, mainly that large growth square of our Morningstar style box, that has prevailed at the expense of almost everything else. So if you haven't revisited your portfolio's intra-asset class allocation, I'd take a look at that. Also take a look at non-U.S. relative to U.S. And non-U.S. has been a very hard sell for U.S. investors, thinking about that recency bias, how we like to think that the past will keep repeating itself. Investors have been very reticent to add non-U.S. exposure to their portfolios. People like me have been saying they should do it. But I really do think that that non-U.S. diversification will at some point pay off for investors, and they'll be very glad that they had it. You think back to the period of 2000 through 2009, for example, kind of a dead period for U.S. equities where U.S. stocks basically flatlined.
Yeah.
On the other hand, international stocks had a banner decade. And I think, especially due to the combination of relatively low valuations overseas, as well as higher dividends on an ongoing basis overseas, those two things, I think, stack the deck in favor of non-U.S. outperforming at some point in time. But when that will happen, I think, is a very big open question.
I'm glad you brought that up. I know some of the great work that you do, your own podcast there at Morningstar called The Long View, and you had a guest on. You were talking about that international investing component. So I found that really interesting, and I'm glad you brought that up. Let's talk briefly about the rotation that we're seeing. You alluded to it there. I mean, we've gone from this kind of big cap Mag 7 market to a crazy, violent rotation here in the last couple of weeks. Is this something that people need to be thinking is longer term? Is this just sort of noise signal? I'm kind of curious about your thoughts on that.
Well, I do think it's a good example of why you want to stay diversified. I'm a huge believer in approaching investing with a lot of humility. And the way that we express humility, the way we kind of say, I don't know, is to diversify across different parts of the market. So the rotation that we've seen, the kind of rotation, whether it's lasting or not, I have no idea. But that's why we do diversify across the style box, why we don't just huddle in that large growth square, which of course has the most impressive performance over the past decade. You want to make room for the manufacturers and the small cap value companies that have recently enjoyed a little bit of a recovery, because you want to have them in your portfolio for when they eventually recover. I do think that interest rates are probably in the mix a little bit with this expectation that the Fed is going to lower interest rates in the latter part of this year. I think that's what's giving some fuel to those smaller cap and value oriented companies, because they tend to be a little more highly leveraged as businesses on an ongoing basis. So they're more responsive to changes in interest rates. The large cap growth stocks, on the other hand, those are companies that don't need to borrow. So they tend to be relatively less, they tend to benefit relatively less from lower interest rates than do the more leveraged companies.
Got it. Let me pivot a little bit here. I mean, the election's on everybody's mind, and, we don't need to stray too far into the political arena, but I am curious, since it pertains to personal finances with taxes, are there any kind of tax implications that, regardless of whether the Republicans win, the Democrats win, Trump, Harris, whomever, what are your thoughts on tax implications? Are there things people need to either be doing now or think about doing after we get through the election?
Yeah, I would say with respect to taxes, one, it's one of the greatest levers that you have as an investor. It's actually an area, even though you view your taxes as like something of an inevitability, it is an area where we investors do exert some level of control over the tax bills related to our investment portfolios. So thinking about, when you decide to sell a position, well, that depends in part on your own personal tax situation. So I like the idea of investors really giving some thought to what they're doing in terms of their portfolio's tax positioning. If you're not comfy with tax matters, get an advisor to help you with this, or use a tax advisor to help guide your choices. I think there is probably the expectation that a Trump administration would be a little bit more tax friendly than would be the case with a Democratic administration, because we do have this packet of tax breaks that are set to sunset or effectively expire. It seems like a Republican president in Congress might be a little bit more favorable toward continuing those tax breaks. But one thing I always think is you have to plan with the tax laws that we have. So if I'm approaching tax positioning today, I probably wouldn't get too into trying to forecast the tax scenario. I would probably think about, okay, what's set to happen with respect to taxes, and do my planning accordingly.
Sounds good. Sounds good. One other issue that you recently were talking about was insurance, long-term care insurance, and had some thoughts on that. Since it's in the news, it's something that people are talking about. What are kind of some of the benefits and drawbacks or considerations people should be looking at there, whether to buy or whether to self-fund, or some of the different options they have?
It's a super tough area, and I would say that there aren't any great solutions, unfortunately. Many people are aware that older adults can get socked with these very high long-term care costs, often toward the tail end of their lives, and that has the effect of depleting a lot of their retirement portfolio. So there are a few key ways to address long-term care risk. You alluded to some of them. One is to purchase insurance. And I think the unfortunate fact of the insurance market is that we've seen premiums really skyrocket over the past couple of decades, where you had older adults who thought they were doing exactly the right thing by purchasing insurance. They've had to contend with very high premiums. And there are a lot of reasons why this has happened. One of the big ones is that we had interest rates be so low for so long that if insurers are taking in the premiums, they just can't invest them in anything that earns much of a return to keep the money safe. So the insurance space is troubled. One category that has come on strong to replace kind of the pure long-term care insurance is what's called a hybrid insurance product. And this would typically be a life insurance policy with a long-term care rider bolted on it. There are also annuities that work kind of in the same way, where it's an annuity with a long-term care rider. That can be kind of an elegant solution, in my opinion, for the older adult who has pure life insurance, but no longer has dependents. So your kids have graduated from college, but you have this whole life insurance policy. You can do what's called a 1035 exchange from that policy into one of these hybrid policies. Unfortunately, the hybrid policies are complicated. So I would say get some unbiased advice to help you evaluate your choices, but that can be something to look at. For self-funders, and this is a group that I often encounter, people who have decided, okay, I'm just going to set aside a portion of my portfolio to cover the long-term care expenses. The tricky part is that we don't know who will encounter long-term care, and you don't know how much to set aside. But the typical long-term care need is fairly abbreviated. The problem is that some people have much longer long-term care needs. And this is especially true for healthier, wealthier older adults who unfortunately are more likely to run into cognitive decline. So kind of healthy body, but yet a mind that is failing. And we all know people like this. And so in that case, those are unfortunately some of the people who will have the longest long-term care need, because they don't have physical ailments, but nonetheless, they need help with those activities of daily living.
Yeah. Christine, in the time we have left, I do want to, of course, mention, you've got a book coming out in September, How to Retire, 20 Lessons for a Happy, Successful, and Wealthy Retirement, which sounds wonderful. Without giving too much away, what are people going to get in that book? What are some of the things that they're going to learn from that when it's released?
Well, Mike, you referenced that I've been doing this podcast now for 5 years every week. And I had the chance to run across some of the preeminent retirement experts in the U.S. In the course of my interviews. And each chapter is an interview with one of those individuals about how to do some aspect of your retirement. So as the project evolved, it had originally started to be one focused very much on portfolio planning, all of the financial aspects of retirement. But as I've gotten more steeped in the topic, I've realized that the decision about whether and when to retire is much less than half financial. It's certainly an investment and financial decision, but it's also one where you want to take into account other things that constitute your quality of life. So, what will you do to replace the purpose that you had with your job? What will you do to replace those relationships that you perhaps had with your job?
Sure.
What will you do to maintain your health in retirement? So it delves into financial and non-financial aspects of retirement, which to my mind are very much related.
Absolutely. Absolutely. I guess the one last question while we're on the topics of sneak peeks, you're going to be joining us for the Money Show Traders Expo in Orlando. That's coming up October 17th to 19th. We're still a few months out, but are there any little bit of nuggets of wisdom, I guess you could suggest that you're going to be talking about there?
Yes, I am going to be talking about the bucket approach to retirement portfolio construction, which is something that I covered in the book. And in fact, we turned the tables and did the interview with me on that topic. It's a topic that I was interested in delving into after talking to the financial planner Harold Ovensky a couple of decades ago. And he talked about this bucket strategy as one that's especially effective in terms of helping you manage your emotional responses to portfolio fluctuations in retirement. So I'll be talking about how to create your own bucket portfolio. I'll be sharing some model portfolios that harness our analyst team's great research. These will be portfolios that consist of mutual funds and exchange traded funds for both taxable and tax sheltered accounts.
Great. Well, Christine, thank you so much for taking some time out, share some of your insights here. Viewers, if you're watching again and you want to learn more from Christine, she's going to be joining us for that Money Show Traders Expo conference. It's at the Omni Orlando Resort at Champions Gate, October 17th to 19th. You can find out more in the link in the video description below. Christine, pleasure speaking with you. Have a great day.
Mike, thank you so much. You have a great day too.